Looks like we are starting to get everybody here. Thank you so much for joining us for our second quarterly market update with Diazo Wealth. Again, I'm Justin Long. Nice to see everybody that was able to join us and take some time to spend some time going over what was in Q2, looking forward to Q3 and the coming quarters, and what that means for the markets, and where we're going and where we're headed. We did have a special guest that was going to join us, Mr. Corey Tushin, and unfortunately Corey has fallen ill, and out of an abundance of caution, we asked Corey to, we're going to go ahead and let him stay home. Corey, we hope you're feeling better. Me and him will get together in the next couple of days as he starts to feel better and get a video out to everybody with an update with the overall Las Vegas real estate market to it. So as we delve into this and we start to look at things, the overall market, how the market performed in Q2, we're going to go over, there's a lot of data with these slides that we'll go through. We'll take some Q&A anytime you want. If you want to go ahead and put questions in the chat, we'll address those as soon as we've gotten through the majority of these slides. I'm happy to go through those and make sure everybody gets their questions answered. And as always, we can chat afterwards on a one-on-one basis. So we're going to get started with the slideshows and go over what was in Q2. All right, so let me just get these pulled up here and get that shared. Give me 1 second. Okay. All right, so again, welcome to the Diazo Wealth Q2 quarterly market update. We'll go through this. I've got about 37 slides. It'll probably take us 25, 30 minutes to go through the slides and the data points, and then we'll answer a Q&A as they come up and go from there. So let's dive into the agenda. The first thing is we're going to cover the macroeconomic situation, and we're going to go through and look at what that means. Hot topics we'll cover, longer term perspectives, and then we'll also go through question and answer. So from there, let's cover the macro investment environment to start with. So the first slide that we're going to go to, it's a little bit of a busy slide. So this one's got a lot of economic to it. It really drives home a lot of different things going on. This is an update as of, I believe, last Friday that we're looking at. The real big things we want to look at here are the blue arrows, and that's real GDP and the unemployment rate. So we know through this pandemic the things that have mostly affected, first the market, second the overall economy. When we look at GDP, we had an estimate of about 31% GDP shrinkage. We actually know that number came in just a little bit above that at 32.9% last Thursday. And unemployment rate, we're looking, we've had a couple of upticks the last couple of weeks when it comes to unemployment, but we're also looking at the overall job number from July that should be out this Friday. And on our weekly update, I'll share those information with you. So as we move on to the next slide, we're looking at the macro investment environment. Charts on these slides show primary economic indicators widely observed and followed. The top one on the left is from one source, that's the IMF, followed in a clockwise order. Then there's ISM manufacturing data. You can see the uptick at the end of the ISM, and that number also should be out tomorrow as well. So we'll keep a close eye on that. Building permits, you can see, have steadily continued to climb as housing has held up through most of this pandemic. And then the index of leading indicators, you can see that swift decline there in the last couple of months with a little bit of reversion to the mean there in the following month, or the last month of the year. So we were pushing 15% on the negative side. Now we've seen it pull back up to about 8.6%. So that gives us a little bit of indication of the upward swing that we're seeing that we want to keep a close eye on. And then, you know, the next piece is we're looking at year-over-year industrial production, the non-farm unemployment rate, or the non-farm employment rate, which we've seen was moved significantly lower. I mean, that's a huge drop down to 20,000, and then right back up the following month. So that gives us a little bit of hope for a much more robust improvement in employment and retail sales. So on to the next slide. The leading indicators, these are the top 4 contributors. So 70% in the leading indicators, the LEI, manufacturing hours, were off just a little couple of weeks, but up from April lows. So new orders are strongly up as discussed, and the interest rate spread again is in positive territory, albeit with lower rates across the yield curve. We've seen that as interest rates have moved down and the Fed has continued to provide stimulus and cut the Fed funds rate. We have seen that move, that spread has started to spread back out, which is always a good sign. Again, albeit low. So the U.S. consumer, the pandemic, we saw us move down, and now we're starting to see that slow back. And all of this, March and April were some of the worst economic quarters we've seen, or months we've seen, with GDP coming out last Thursday at that negative 32.9%. That is the worst quarter we've ever seen. And now it's that slow crawl back to normalcy that we're. The next slide, more of the macro. So the consumer is something we always keep a close eye on, and we've seen that kind of drop and kind of flatten out. Inflation has been very muted, in spite of the thing that we're seeing from the Fed stimulus. So we'll have to see long-term how that plays out. We do have a Fed funds rate, the upper bond up in the upper right-hand corner of this slide. The Federal Reserve has dropped all the way to 0 to 0.25% on their target funds rate. We were close to 2% prior to the pandemic, and they immediately stepped in and provided that liquidity to the market. And to touch on it a little further, the United States Treasury yield curve is in the lower left-hand corner. You can see how they came together, and now they've started to spread back out, which is always a positive sign for the economy as we start to see that spreading of the yield curve. And in comparison, if we go to the bottom right-hand corner, we've got the UK, we've got Germany, the United States, Japan, and you see all yields have significantly moved down over time, and almost to the point that they're all in lockstep for the most part, moving further and further closer to that 0 point. And as we've discussed in many meetings, Japan has been in a zero interest rate environment for a significant amount of time. The Fed talking about that looks like we may end up with a significant portion of the next couple of years in that very low interest rate environment we've seen. So we'll want to keep a close eye on that as well. So as we move to the next slide, we're going to talk a little bit more, excuse me, about the Treasury spread. And we've seen that. Oh, hold on, technical difficulties. Click the wrong button there. Sorry. The U.S. Treasury spread, the 10-year to the one we really want to keep a close eye on. And as you can see, a couple of months ago, it got compressed quite a bit, not quite to a negative interest rate environment. As you can see, if we go back to 99 and 2000, we actually saw an inverted yield curve, and that was the last time we saw it briefly in 06 and 07. But you can see we still have some sort of a yield spread at 44 basis points or so between the 2-year and the 10-year. The unemployment rate, 3-month moving average, this is the one that really hits Main Street hard. When we look, we were going through February, we were at that unemployment rate of just under 4%, considered full employment. Inflation was starting to get where the Fed wanted it at the 2% mark. We were moving north, and then obviously COVID-19 happens. The layoffs are exorbitant, and we've spiked our unemployment rate up to as high as 15%. Now we've moved it down to a level at 13 and then 11. Again, we'll have more solid figures this weekend when we send out the overall weekly report that'll have the economic calendar from this week. The probability of recession is, greatly measured when we look at the USA recession probability Treasury spread. Again, the percentage has moved up as that spread has compressed. You can see there on that slide. And then we talk about tightening credit, which is, if you really take a deep look at that, if you look in the gray bar, the last two major recessions that we saw, one was in 2000 with the tech bubble, and then we saw the financial crisis in 08, 09. So if you look at those spikes that we see there in tightening of credit, which means lending gets a little more difficult, you can see in the 2000s it moved up a little bit, and obviously with the financial crisis in 08, 09, we saw a significant move higher. We've started to see that happening now. We don't quite know what the effects of that are going to be when we look at the overall economic situation, as a lot of the forbearance and foreclosure situations that we are looking at being a possibility, those continue to get the can kicked down the road. So we'll want to keep a very close eye on that and how that affects our portfolios. The next slide is not quite so busy, which is a little bit more fun and a little bit easier. So this puts it in a little more context. We're nowhere near to either the Great Depression as far as recessionary pressures. And if we take a close look, most of our recessions here in the US last somewhere between 3 to 4 quarters. So 9 to 12 months is kind of the average. Technically speaking, we're 2 quarters into this, so we're 4 months already into this recession. And a recession, as we've discussed in the past, is 2 consecutive quarters in a negative fashion. We've seen that consecutively with a 5% downturn in Q1 from the effects from the pandemic, and then again the 32.9% record-setting pullback of GDP in Q2. But you can see here the severity of it. 12% decline in real GDP if you go up to the upper left-hand corner, 26% in the Great Depression, and we've had multiple recessions throughout our time that we've kind of seen. So it's a little bit closer to probably post-World War II demobilization as far as a decline in real GDP versus the Great Depression, which I know we've had many conversations about. So as we move on to the next one, we want to look at global indicators. And when the data that we have here are primary indicators among leading world economies, not just the US. When we take a look at the economic data of Q1, which FactSet uses to make data comparable, given the lag in international reporting versus sole US data. So some of this is still a little bit stale dated. Real GDP, we saw China shrink. We look at the Fed funds target rate, we're down 100 basis points on a trend. And then energy and crude oil, as we saw throughout the pandemic, we got below that $20 a barrel and even went negative on futures for a couple of days. Seems to have straightened itself out a little bit, hovering around that $40 a barrel mark. When we talk about gold and silver, we have seen significant spikes, and we've even moved north from those points since we pulled this data just a couple of days ago. The next piece is we're going to look at GDP from the 2019 year. So when we look at the GDP on the next slide, we're going to look at the overall global economy. So obviously, more green is good, red is bad. So when we look at in 2019, we had a relatively solid year across the board. The exceptions are those countries that seem to be mostly exposed to natural resource exports, especially oil. So you can see the smattering of red in 2019, with the majority of countries being in the green, 0 to 3%, a little, some in 3 to 6, and some 6% and higher. And then we had a couple that were in negative fashion. Now the next slide we're going to move to is the 2020. A little more red here, obviously, with the pandemic coming into play. We have seen negative real GDP growth by most countries. Surprisingly, we have seen some growth out of China and India still. So that gives us some indication of a recovery process, and maybe we'll see that cycle through other economies. On a positive note, as we move to the next slide, the expectation of 2021 real GDP calls for a full-scale global recovery to growth, including many economies hit by last year's commodity price changes. To a large extent, this is what we've seen reflected in asset prices since that March 23rd low that we saw in the market. So in summary, we'll go to the next slide and we'll just kind of bounce through this. Global recession in 2020, COVID-19 and the aftermath that we've seen. Markets did take a steep step back from about the middle of February till the 23rd of March, and have begun to recover and build since then. There is some things that we want to keep an eye on. Reopenings seem to be staggered and interrupted as different states have different reporting, and we'll want to definitely make sure that we're keeping a close eye on that. Huge amounts of fiscal and monetary stimulus, and more likely to come. I know we're watching closely as the Congress and Senate go back and forth to decide on what the next stimulus package looks like. And then we've got the U.S. election for both Congress, Senate, and the presidency coming in November. The big thing we really want to keep a focus on is global recovery moving forward in 2021 and 2022, living a new normal. A vaccine is anticipated, but we'll want to make sure we keep a close eye on how that works out. And herd immunity continues to rise, but again, data comes in on a daily basis. We really don't know what that's going to look like. So again, constant communication. I'll be making sure that we get information out to all of our clients to ensure that we know where that is and what that looks like. And then the markets begin to kind of focus on fundamental recovery and government-induced liquidity. So that's kind of something we'll want to keep a close eye on as well, what that stimulus package looks like, where we are with it, and who it helps and where we end up. So the next thing we're going to look at is a little bit in the capital markets area, more so less of the macro for the global economy, more so in capital markets. So as we move on to equity class, asset class returns, this is a slide I always like to share with a lot of folks. This is something that we go over in depth, and you can see here how asset allocation just kind of stays right there in the middle. You can't ever pick a winner or loser that's consistent, but making sure we're tilting our portfolios appropriately for your risk to ensure that where we are and what we're doing is appropriate for you. 15 years of total returns in this slide, and just reinforces that diversity really comes in handy given economic indicators and where we are in the world. When we look at the next slide, it's the S&P 500 technical. So like we said, significant downward move beginning in late February, all the way again to that March 23rd date. We have seen a significant improvement since then, and we are sitting just slightly below the S&P February high of 3380 after today. We were up just a tick today. This is a strong reflection of government stimulus and support measures, and hopefully those bleed into an economic recovery as well, as we previously reviewed. The next thing is looking at the sector fundamentals. So again, this is a little bit of a busy slide as well. Couple of takeaways as we look into the economic sector. The market is not overvalued when we look at sector price earnings ratios versus expected growth. If you take a pure PE number, year over year right now, we're significantly higher than our normal, but the expected growth, so that's the if we're looking at the green arrows there, the fiscal year 1 and 2 change, we should see that kind of start to balance itself out with earnings coming out. Another section that we always like to talk about is fixed income with a lot of our clients. So the fixed income class returns, again, here's another 15 years. Another case for diversity when we're looking at core intermediate investment grade bonds, consistency and performance during periods of stress have helped us with that sleep well at night mentality that we give most of our clients. Again, when we look at this, it's fantastic that we can look at it and see what year over year does. And if we had a crystal ball, we'd just pick the one at the top. But staying consistent, maintaining our risk profile, and really understanding what the goals are for what a portfolio looks like is something we lean on here. Another big slide here's the Federal Reserve policy rate forecast. As you can see, we were slowly moving up from about 2015, 09 to 15. We were stuck at a static rate, very low, 0.25%. We started to see slow interest rate increases over time, and what we were seeing moving into a positive economy. Real GDP shrinkage of 6.5% for 2020 is the estimates. Growth in 2021 of 5% and 2022 of 3.5%. Unemployment rates we're estimating, and these come from the Federal Reserve. So the estimate is 9.3% or so of the unemployment rate, with an even lower rate in 2021. Still further low at 5.5% in 2022. And then long run, getting back to that 4% unemployment rate, which is ultimately the goal and considered full employment. Looking at inflation, fourth quarter to fourth quarter, 2020, a much lower rate than we've seen over the last few years at 0.8, doubling that and going to 1.6. This is when we start to see that normalization of Fed funds rates, and then 2022 up to 1.7. Long run, again, the U.S. typically shoots for that 2% when we're talking about overall inflationary measures that we would like to see. So obviously the topic that is on most people's mind when we have these conversations is the COVID-19 and the pandemic. So we'll talk about that. We'll have a couple of slides briefly to go over and talk about what that looks like and where we're headed with that. So as we move to the next slide, the total cases we can see are continuing to increase, active cases as well. New cases versus recoveries and total cured are also moving up. Now, what cured means is it's 2 negative tests, and we're seeing more and more data that we have to be cognizant of what that actually means. Most people know I'm a pretty big baseball fan, and Eduardo Rodriguez from the Boston Red Sox came out this week, and he has been cured by 2 negative tests is what that means of COVID-19 since early March. But now he's having heart difficulties and he's out for the season. So the long-term healthcare ramifications of what this disease means is still anybody's guess. So fantastic news that new cases and new recoveries are moving in the right direction. Hopefully we start to get a handle on the total cases that are out there. But we'll have to make sure we keep a long-term eye on the long-term lasting effects. So we move on. The overall, we look at the death rates, total serious critical cases. A lot of these data points are available out there if we're looking at different places. The expectations of outcome with total closed cases versus death rate seems to be making a slight improvement. The total serious critical cases is still moving up, but not at the same rate of the total cases rate. So we're hoping that continues. The underlying pre-existing conditions are obviously still the biggest thing we want to be cognizant of. But again, when we go back to our Boston Red Sox that's out for this season, he was healthy young man, 27 years old and an athlete. We still don't know the long-term ramifications, so we'll definitely want to keep an eye on that. Big part of what has happened with the coronavirus has been global government stimulus. So the World Economic Programs against the coronavirus, you can see here, the U.S. is $2.3 trillion into their support of the overall pandemic. Japan at $5.2 billion. Australia coming in at 133 billion. And you can see the color coded as a percent of GDP, which is always an important number. Another reason asset prices have recovered, most notably and importantly, fixed income securities have come back as the global bond market is twice the size of the global equity market. Our current fixed income market sits at about 115 trillion versus the 50 trillion in the equity market. So this is really what's caused the recovery that we've seen in the overall market, is the stimulus from the US government. And again, we continue to believe that there will be some further stimulus as the US representatives and the senators continue to negotiate. The types of stimulus by country has been a little bit of a dichotomy. We have a big focus in some of our other allies in Europe and things like that was more on loans and equity guarantees, where the U.S. focused on spending and revenue measures to kind of kickstart that economy. And it being the largest economy in the world, there needs to be fuel in it for it to run. A couple of different approaches we've seen here: less direct federal government spending, more tax cuts outside of the US, things like that. The high frequency industry recoveries that we've seen on the next slide is something that we'll go over. So mortgage purchase applications have actually returned to positive from pre-COVID pandemic. We still are seeing seated diners. Obviously, you can see the minimum. There were absolutely none. That's reservations made. We're still 65% below pre-COVID numbers. TSA traveler traffic is still almost 80% lower. An interesting one is driving direction usage is back up above pre-COVID information. So that's something to keep an eye on. That means people are out there and moving around, and obviously airlines seem to be the slowest to recover. Hotel occupancy, being here in Las Vegas, we get a front row seat to that and what that looks like. We're still seeing fairly low numbers when it comes to that, with some improvement. And then we'll move on to the Q2 earnings. From Q2, we're about 2 weeks into Q2 earnings season. The percentage of S&P 500 companies reporting results that are either in line or better than expected is higher than anticipated. Some of that may have to do with a lot of the negative perception. And I mean, we had Goldman Sachs estimating a 50% drop in GDP at some point. There was a 10% in there. So analysts have kind of never been in this position. We've never turned the faucet of the US off. So take this with a grain of salt. Yes, earnings are coming in better than expected, but we'll want to be really cognizant of future forecasts to make sure that we weren't just looking at things that were going to be so bad, and they're still pretty terrible, but not as terrible as we thought. So we'll want to keep a really close eye on that. We'll cover a little bit longer term perspective. So this is economic cycles, year over year, a little bit on behavioral finance, and some odds that we'll cover. So as we move on this, something I like to say when I work with clients is we're either in the middle of the next crisis or planning for the next one. You can see here over the, the last 80 years, since 1940, we've seen 116 major geopolitical, economic, or market situations that caused worry and were the focus of the news cycle, and kind of gave everybody cause for pause. And that's more so the reason we talk about that in depth is we're currently in a crisis. We come out of this one, we're still going to be planning for the next one because there's always something out there. That's why the prudent planning that we want to always put in place, we always want to make sure that we're comfortable in any market, that we're in a situation where we can withstand it and move forward. And another one that we always like to cover is the intra-year declines. So you can see here, these black dots at the bottom of the slide are the lowest point for per year, and then the gray bars are where we ended up for that year. So if you look at, a great example is this year to date. Low point is negative 34%. Current is negative 4%. We've actually moved up a little bit from there. 2018, we're looking at a negative 20% at one point during the year, negative 6% for the year over year, negative 3% in 2016, and we ended up with a 19% positive. So typically we see a intra-year low point at some point that gives us that cause for concern, what's going on and where we're at. This is why I love having conversations and making sure that we're getting a plan in place and we're really happy with where things are, because these downsides are going to happen. It's what do we get out of it, and where do we sidestep and make our moves? 30 of the last 40 years, the S&P 500 has been positive. So we always like to keep a positive outlook on things. Effects of not doing that, you can see here, U.S. stock market on average of since 1987 is just north of 10%. We have several asset classes that have performed well, and then through many Dalbar statas and Bloomberg, Clearbridge, things like that, we've seen the average investor return, allowing those worries to get to us when we really should stick to it, and those intra-year lows get the better of us. The average investor averages about 2.6%. I know I'm coming up on time here. I'm long-winded as usual, but we've just got a couple more slides here. Typically median quarters, 3 out of 4, 6 to 7 to 1 of economic expansion versus contractions. So basically for every 6.5, call it in the middle, of economic expansion quarters we've seen 1 contraction, and that's going back all the way back to World War II. The average length of recessions has been those 9 months, and like I said, we're about 4 or so months into the current one. And the average length of expansions, now we did have a longer run of the expansion that we saw from 2008 till it was officially just over 10 years, but the average is about 5 years. So as we come out of the recession here, we will probably start to see recovery and a pretty good glide path to long-term success for a couple of years anyway. So I know I went a little bit longer than I had anticipated, but I do want to thank everybody for being here, and really do appreciate everything, working with us, getting information, and just communicating and letting everybody know where we're at and what's going on. So I will pull up the questions here and go over some Q&A and be happy to answer some questions, and we'll go from there. Any questions out there that I can answer? Is the Q&A working? Again, if you have any questions, just go ahead and throw it there in the chat, and I'll be happy to answer them. Okay, so the question is where do we see this affecting mortgage rates? Mortgage rates are at all-time lows. If you've met with me recently, that's probably something we've brought up and made sure we've addressed whether or not it makes sense to move to a lower rate, or if where you are makes sense. I was reading an article today that what would it take to get mortgage rates on a 30-year fix below where they are currently. I mean, we have a 10-year treasury note, which is what the mortgage rate is based off of, currently sitting, it vacillates between 0.5 and 0.7% on a weekly basis. I would be surprised if we saw it move entirely lower, but again, this situation that we're in is so unprecedented that we really don't know where we're headed. Again, I've been studying mortgage rates for 20 some odd years. This is the lowest I've ever seen them. So we'll keep a close eye on them. And if you have questions, we have great partners that we work with that we can find out some more detailed information. Hope that answered your question. Absolutely. So what I will do is after today, once we get this all buttoned up and put together, we will email the entire recording and the link to it. It'll be on our YouTube page. You'll be able to access it whenever you want. I'll send everybody a thank you and a link to the recording that you can share with friends, families, or those that you feel like would benefit from it. So that's a great question. So the question is there's a huge difference between market recovery and economic recovery, and that is something that we hear quite often. The market is a leading indicator. It's speculative in nature, always has been since its foundation. It has always been ahead of the curve, and it's betting that the stimulus that we're seeing from the government and the resiliency of the U.S. and the really good quality companies that are out there continue to do business, and the American economy is able to restart and continue being the top economy in the world through partnerships and trade agreements as we continue to make those. But yes, there is a disparity as we see the unemployment rate still north of 10%. We still have 35 million unemployed, people still looking for stimulus checks as we continue to see possible shutdowns in other places. I know Las Vegas has closed bars again. I believe California has. So again, unprecedented situation, and the market is betting on the resiliency of the U.S. economy. But there is that disparity, and as we continue to monitor that, we'll want to see those come to congruence. And if there continues to be that disparity, we'll probably want to expand on that and have a deeper conversation what that means long term. So the question is how are we managing our portfolios differently and adjusting them in this environment? So our overall methodology, our investment philosophy is to utilize quality companies, high on cash, good earnings, quality names that we've seen success over time. We have added a couple of different types of portfolios, a recovery momentum portfolio that we look at that we feel there are companies that have been oversold possibly to the point that maybe they don't recover 100%, but if they've been sold off 70 or 80%, you know, even if they were to recover half of that, it could give our investors a solid return. And also we're revisiting on a regular basis what risk means to everybody. We have those conversations on a fairly regular basis, but with the volatility that we've seen and the continued uncertainty that we're seeing, we continue to revisit that and drive that home, because that is really what drives our Sleep Well at Night program. That's really what drives you as an investor to be comfortable and understand where you are and what you're doing. So those are some of the adjustments we're making on the portfolio side, and then just on the relationship side, it's constant communication. It's making sure that people are comfortable and we know what's going on in their situation, and if something drastically has changed, we adjust our plan accordingly. So those are a couple of quick questions. Again, I appreciate everybody's time and efforts to come visit with us on a yet another hot Las Vegas summer day. If you want to reach out, Nick, if you'll go to the next slide, I'm pretty sure everybody has our address, our email addresses, but you can call me, you can call Nick. Happy to discuss any of this offline with anybody at a greater level, really dig in on what it means for your personal situation, and make sure that you're comfortable and where you want to be. And yeah, thank you and have a wonderful day. Again, I really appreciate the time, and please reach out with any questions. Thank you, everybody. Have a great day.